When you are self-employed, the last thing you want to deal with is an audit. But no worries, in this video, I'm going to show you the 5 red flags that might put you at risk of being audited and how to avoid them right before tax time. Before we get into the actual 5 red flags of an audit, let's break down what an audit actually is. And in the most simplest terms, an audit is simply a checkup. An audit from the IRS perspective says, hey, we just want to double check and make sure that what you reported on your income is accurate. So the first red flag is failing to report all of your income. That is probably one of the biggest audit triggers for someone who is self-employed. Oftentimes when we're self-employed, we depend on receiving 1099s. But if we're being honest with ourselves, not everybody sends us a 1099. And just because we're not sent a 1099 does not mean that we are not obligated to report all of our income. It is our responsibility to make sure that we are tracking every single penny that comes into our business. Now, moving on to the second red flag, which is taking higher than average deductions. Mainly in this one, I'm talking about, deducting the meals, the travel, and entertainment. The IRS knows what the average deduction is for certain type of expenses. So when we as self-employed individuals have a higher than average deduction, it triggers a red flag. Do what you need to do to make your income. Just make sure that it is for business, and what you can do to actually help yourself is on the back of the receipt. You can write the person's name that you had the business meeting with at dinner, obviously the date, and what you discussed. If you have those 3 things and you can substantiate that for every meal that you have, then you're okay. And now here we are at the third red flag, which is claiming 100% business use for personal use items. If you are a sole proprietor or a single member LLC and your one vehicle that you use is 100% business use and you therefore take 100% deduction, no, that's not gonna fly. Now, keep in mind, we can use these items for business and therefore write them off. We just cannot say that it was 100% used for business. For your vehicle, what I always recommend is that come January 1st, you write down your odometer reading on that day, and on December 31st, you write down your odometer reading on that day. And what happens in between, you will say, okay, of this mileage, this is how much I used for business. And that will give you a percent. It's not 100%, it's 75%. And based on that, you'd be able to write off 75% of the gas that you used, 75% of the maintenance, oil changes, the tires, anything like that. The fourth red flag is taking losses. But here's the thing, losses are natural. I encourage everybody that if you have a loss, don't be afraid to take it. As a matter of fact, some business owners don't file taxes because they say, well, I didn't earn nothing, so I don't need to file. Things do happen, that's part of business, that's the joy of the journey. But making sure that we do our best not to take more than 2 years worth of losses in a row, because that will definitely cause the IRS to raise their eyebrow and say, hey, is this a business or is this a hobby? And for the 5th and final red flag that will definitely put you on the radar of the IRS is 5s and 0s. And what I mean by 5s and 0s is a lot of time when it comes to tax time, what we do is we like to look up at the ceiling tiles and make guesses. Like, well, on advertising, I think I spent around $10,000. On my supplies, I spent $55. But did you hear what I was doing? Everything ended in a 0. Everything ended in a 5. There is no perfect round number worth of expenses, and listing those zeros and those fives is telling the IRS that you did not track your expenses properly, and the IRS goal is all about accuracy. So now that we've done all 5 of the red flags, here's something that I want you to do right now before tax day. 1, if you haven't done so already, get you a business bank account. Don't commingle personal funds. Make sure you keep everything separate. And 2, get you a system that will track the expenses that go inside of that business bank account. Simple. You can do that before tax day. You'll be good to go.